The stock market's 9 to 5 schedule is a dinosaur. It's an artifact from a time of physical trading floors and bankers in suits taking 2 hour lunches. In our hyper-connected world, a market that sleeps just feels wrong. And a lot of powerful people agree. You hear everyone from crypto startups to BlackRock, the biggest asset manager on earth, hyping up the next big thing, tokenization. The idea sounds simple, even revolutionary. Turn real world assets like stocks into digital tokens on a blockchain. This could unlock the holy grail of finance, a market that's open for everyone 24 hours a day, 7 days a week. They say it's the future. They promise instant settlement, global access, and a democratization of wealth. But is that the whole story? Is this an investor's dream come true? Or is it a speculator's trap, repackaging old risks into a shiny, new, always on casino? There's a flood of marketing hype, but not a lot of straight answers. So I decided to be the guinea pig. I took $1,000 of my own money, and for 7 straight days, I dove headfirst into this new world of 24/7 stock trading. I wanted to see what they aren't telling us. I traded at 3 a.m. I tried to buy on a Sunday. And I documented every single step of what happens when you actually try to get your money out. The results were not what I expected. The promise of a 24/7 market is intoxicating. A huge story breaks in Asia overnight, and you, from your couch in Ohio, can act on it instantly. No more waiting for the opening bell, helplessly watching the pre market go haywire. It sounds like the ultimate level playing field. But as I found out, the reality is far more complex and, honestly, far more treacherous than the brochures let on. This isn't just about new tech. It's about what happens when human psychology collides with a market that never, ever lets you rest. Before we get into the experiment, let's talk about the problem 24/7 trading claims to solve. The traditional stock market runs on a schedule that feels totally arbitrary now. The main session for the NYSE and NASDAQ runs from 9:30 a.m. to 4:00 p.m. Eastern Time. That's it. For anyone living outside that time zone, it's incredibly restrictive. Sure, there's pre market and after hours trading, but let's be real. That's not a solution for the average person. It's a murky world with low liquidity, insane spreads, and it's completely dominated by big institutions and high frequency traders. It's like being invited to a party, but you're stuck in the lobby while the real fun is happening in a VIP room you can't get into. The result is a financial system that feels walled off by time and geography. An investor in Tokyo has a fundamentally different experience than one in New York, and that just feels ancient in 2025. This is where tokenization swoops in, pitched as the great equalizer. The idea is to take something like a share of Apple stock and create a digital stand in for it, a token that lives on a blockchain. This token can then be traded on digital platforms, completely free from Wall Street's 9 to 5 schedule. The marketing is powerful. They promise three big things. First, 24/7 365 global access. Second, fractional ownership, so you can buy $10 worth of a pricey stock. And third, instant settlement, where trades happen in seconds, not the 2 days it takes in the old system. It sounds like a perfect, frictionless utopia, but the devil is always in the details. So I laid out the rules for my little investigation. First, the goal, not just random day trading. I wanted to simulate a real strategy by building a mini portfolio of tokenized stocks that would mimic the S&P 500. Second, the capital, $1,000 of my own money. This was key. It wasn't play money. Every dollar lost to fees or bad spreads would be a real, tangible loss. Third, the platforms. I used a couple of the more established crypto platforms that offer tokenized stocks. And here's the first little red flag. For legal reasons, many of these are based and regulated outside the United States, a point we'll definitely come back to. Fourth, the duration, 7 straight days, to experience a full weekly cycle, from the weekend quiet to the weekday chaos. And finally, the tests. I was on a mission to answer 5 specific questions. Liquidity, the big one. Can I actually buy and sell for a fair price at 3 a.m.? Or is it a ghost town? The experience. What does it feel like to be chained to a market that never sleeps? What's the psychological cost? The fine print. How do the costs really stack up? I'd track every fee, spread, and bit of slippage and compare it to my boring old brokerage account. Ownership versus exposure. A crucial one. Do I actually own a piece of the company? Do I get voting rights, dividends, or am I just buying a synthetic derivative that tracks the price? The cash out. How easy is it to get my money back into my bank account? With my $1,000 locked and loaded, the experiment began on a Friday evening, right as the traditional markets were closing. Day 1 and 2. The honeymoon and first glitches getting started was surprisingly easy. Setting up an account felt more like signing up for a new app than opening a brokerage account. I transferred in my $1,000 using a stablecoin, a crypto pegged to the US dollar, and I was good to go. My first trade was on a Saturday afternoon. I have to admit, there was a thrill to it. While Wall Street slept, I was building my portfolio. I started buying my tokenized S&P 500 bits, a piece of Apple, a slice of Microsoft, a bit of Nvidia. The interface was clean and minimalist. It felt like the future for a minute. Then I saw the first crack, the spread, the gap between what buyers are willing to pay and what sellers are willing to accept. It's basically a hidden cost. On a stock like Apple during normal hours, the spread is razor thin. Here on a Saturday, it was noticeably wider, maybe a tenth of a percent. That doesn't sound like much, but it's a hidden tax on every single trade. On my $1,000, it was $1 here, $1 there. On $1 million trade, it's $1,000 gone just for the convenience of trading on a weekend. I made a mental note. This convenience had a price. Over the next day, I had a small win. A bit of weekend news gave one of my tech holdings a little bump, and my portfolio ticked up by $15. It was a tiny gain, but it delivered a potent dopamine hit. I had successfully traded on a weekend and made money. It was easy to see how you could get hooked. Day 3 and 4, the ordeal, the 3 a.m. test. This was the moment of truth. On Tuesday night, I set an alarm for 3 a.m. to test the platform's biggest promise, liquidity at any hour. I dragged myself out of bed, opened my laptop, and looked at the market. My plan was simple: sell $200 worth of my tokenized Nvidia stock. If anything had liquidity in the middle of the night, it should be Nvidia. I pulled up the trading screen. The price chart looked frozen. It wasn't the smooth flowing line of a normal trading day. It was a flat line with occasional violent spikes. I put in my sell order, and the quote that came back was a splash of cold water to the face. The price I was offered was nearly 1.5% below what the stock had last traded for on NASDAQ. The spread was a canyon. To sell my $200 of stock, I'd instantly lose $3. Not because the stock's value fell, but because of the hidden cost of this convenient 24/7 market. This is called slippage, the difference between the price you expect and the one you actually get. A 1.5% transaction cost on a major stock is insane. It's the kind of fee you'd expect from a pawn shop, not a sophisticated financial platform. This was the first major revelation. The market is open 24/7, but it's not liquid 24/7. It's an illusion. Outside of the hours when the real markets are open, you're trading in a shallow pond where a few market makers will take your trade, but only at a price that heavily favors them. It's like a 24-hour convenience store. Sure, you can buy milk at 3 a.m., but it's going to cost you double. Day 5, the psychological trap. After the 3 a.m. disaster, the experiment changed for me. I started to notice the psychological toll. When the market never closes, a part of your brain is always on. There's no closing bell to let you disconnect. Every news alert from anywhere in the world becomes a potential trade that needs your immediate attention. On Wednesday at 11 p.m., a story broke about a regulatory probe. In a normal world, I'd read it, think about it, and maybe make a move when the market opened the next morning. But in the 24/7 world, I felt a frantic urgency. The token was already dropping. My mind raced. Sell now. Is this an overreaction? The platform wasn't just offering me an opportunity, it was demanding that I act right now. This is the trap. The system is perfectly designed to make you overtrade. It preys on your FOMO and loss aversion, turning you from a thoughtful investor into a reactive speculator. And every trade you make generates fees for the platform. They have a direct financial incentive to keep you worried and clicking. I found myself checking my phone at dinner, scrolling charts before bed. There's a saying, a portfolio is like a bar of soap. The more you handle it, the smaller it gets. This system was begging me to handle the soap until it vanished. Day 6, the fine print, the ownership question. Next, I dug into what I actually owned. This is where the story went from bad to worse. I timed this test for when one of the companies in my portfolio, let's call it Megacorp, was paying a dividend. In a normal brokerage account, the cash just shows up. Here, I had to dig through the platform's terms of service, the document no one ever reads. What I found was startling. The token I held wasn't a direct share of Megacorp. It was a token issued by a third-party company in a country with lax regulations, which claimed to be backed one for one by a real share held somewhere. This structure has two terrifying implications. First, ownership rights. I had none. No voting rights. No legal claim on the company's assets. I was not a shareholder of Megacorp. I owned a derivative designed to track its price. The dividend did eventually show up, 2 days late and slightly less than it should have been after they took their cut. Second, and way scarier, is counterparty risk. My entire investment hinged on the honesty of this third-party company I'd never heard of. If that company goes bankrupt, or worse, was fraudulent and never held the shares in the first place, my tokens would be worthless. In a regulated US brokerage account, your assets are protected. Here, my only recourse would be trying to navigate the bankruptcy laws of a foreign country. Good luck. This is the biggest secret of the tokenized stock world. You're not buying the stock, you're buying a promise of the stock. You are giving up fundamental rights and safety for the convenience of 24/7 access. Day 7, the climax, cashing out. After 6 days, my experiment was over. My initial $1,000 was now worth about 972 thanks to the system slowly bleeding me through 1,000 tiny cuts. Now for the final test, getting my money out. The promise of instant settlement sounds magical. The reality was anything but. The process was a frustrating multi-step ordeal. First, I had to sell all my tokenized stocks back into a US dollar stablecoin, with each sale getting hit by its own spread and fee. Second, I initiated a withdrawal of the stablecoins to my personal crypto wallet. This on chain part was fast, taking only minutes. This is the part they love to advertise. But stablecoins aren't dollars in my bank. So, third, I had to send them to a major crypto exchange that could convert them to real money, which cost me a network gas fee. Fourth, on that exchange, I had to sell the stablecoins for US dollars, another transaction with its own fee. Finally, with US dollars in my crypto exchange account, I could start a withdrawal to my bank. Was it instant? Of course not. It was a standard bank transfer with a 3-5 business day waiting period. And for one final insult, there was a withdrawal fee. The instant settlement promise is a mirage. Settlement is only instant inside the closed crypto ecosystem. The moment you want to get back to the real world, you're on the same old toll roads, facing the same fees and delays. My $1,000 was down to about $965 after all was said and done, a 3.5% loss with no major market crash and no terrible decisions. The system itself was the loss. So here are the things no one tells you about 24/7 stock trading. Lesson 1, 24/7 open doesn't mean 24/7 liquid. The biggest lie is that the market is the same at 3 a.m. as it is at 3 p.m. It's not. 24/7 access is not 24/7 liquidity. In the off hours, it's a ghost town where market makers charge you a fortune for the privilege of trading. The real US exchanges are exploring 24/5 trading, Monday to Friday, which is a world away from the 24/7 free-for-all on these unregulated platforms. Lesson 2, the system wants you to be a speculator, not an investor. A market that never closes creates perpetual urgency, pushing you to trade more. The platform's business model is built on your trading frequency, not your long-term success. It's designed to bring out the gambler in you. Lesson 3, you don't actually own your stocks. This is the most critical risk. On most of these platforms, you're buying a derivative, a token that gives you exposure to the price. You're sacrificing real ownership rights and adding massive counterparty risk. You're trading the safety of the regulated financial system for the freedom of the Wild West. Lesson 4, cashing out is a hassle, not magic. Instant settlement is a marketing gimmick. The process of getting your money from a token back into your bank account is slow, clunky, and expensive, often more so than just selling a stock on a traditional platform and waiting a couple of days. Now, you might be thinking this whole tokenization thing is a scam. It's more complicated. If it's so bad for retail investors, why are giants like BlackRock and JP Morgan getting involved? The answer is we're not the real customers right now. The true revolution is happening in the financial plumbing. For huge institutions, tokenization can make settling massive trades and things like bonds and funds faster and cheaper. BlackRock's successful Bwiddle fund, which tokenizes US Treasury bills, is a perfect example. It's a tool for large, qualified investors, not for the average person to trade stocks 24/7. They're building a new superhighway for themselves. The apps we see are just the first bumpy, unreliable access roads. So, what's the verdict? Is 24/7 stock trading an investor's dream or a speculator's trap? Right now, for the average retail investor in 2025, it's much closer to a trap. The dream of a future global market is real, but the technology is still in its dial-up era, clunky, slow, and full of hidden dangers. The promise is compelling, but the infrastructure to support it in a safe and fair way for everyone simply isn't here yet. I started this journey hoping to see the future of finance. I wanted to believe in the dream of a truly democratic market. What I found was a system that, in its current form, serves the platforms far more than it serves investors. The biggest risk isn't losing all your money in one bad trade. It's the slow erosion of your capital through hidden fees, the erosion of your peace of mind, and the erosion of your actual ownership rights for the illusion of convenience. But that's just my experience. This world is changing fast. So I want to hear from you. Have you tried trading tokenized stocks? What was your experience? Drop your story in the comments below. I read every single one. And if you want to see more experiments where I put my own money and sanity on the line to find the truth behind the hype, make sure you subscribe. Thanks for watching.